In terms of Asian markets, well, from an equity market perspective, they're clearly taking the lead from U.S. markets overnight. But I think Asian FX is quite interesting because Asian FX, emerging market Asia in particular, has held up much better than other emerging markets. So they're down about somewhere between 2 to 5% versus about 20% in Latin America, let's say. In terms of valuation, many countries in Asia don't look particularly undervalued compared to EM peers, though. So because they haven't sold off that much, they don't look that cheap. And this could, in fact, limit opportunities in Asian FX going forward relative to other EM peers, as investors may be looking for other regions for cheaper currencies. Now, with that said, the Malaysian Ringgit and the Indonesian Rupiah are slightly undervalued compared to their 10-year average and a little bit more undervalued compared to some other Asian peers. And this is likely the result of foreigners holding a higher number of local bonds, and so they get hit with the volatility. And also Malaysia and Indonesia also offer some of the best carry appeal in Asia with real interest rates of around 2%, which is higher than most other countries.
Why are we seeing so much positivity in markets when the data points are looking particularly woeful, double-digit declines, pretty much as far as the eye can see when it comes to Q2 GDP prints?
Yeah, there's an absolute disconnect between the economy and markets. But then again, markets are forward-looking. I would say that U.S. and global equity markets are being supported by both liquidity and hope. So liquidity from central banks around the world as they've been injecting huge amounts of money and cash into the system. And of course, hope in the sense that investors hope that lockdowns will be eased relatively quickly and smoothly and hope that there won't be a second wave of infections. It does help, of course, that President Trump is coming out with slightly less or more positive news, so to speak, around trade negotiations, because that had been a big question mark for investors.
Yeah, how important is that? Of course, we're hearing today of talks between the United States and China, and there had been, of course, some concern out there that we would see a re-escalation of the tensions between China and the United States, of course, post-COVID and in light of the COVID outbreak.
Yeah, that's true. So there were concerns around Chinese transparency of the virus and potential price gouging by Chinese suppliers, right? But really, the crux of the matter is that it was clear for several weeks that Trump was very slow to react to COVID-19, and he downplayed the risks to the U.S. But essentially now he has to find a scapegoat ahead of the November elections, and that's why we're seeing all of this increase in tensions with China and the blame game starting in earnest. And unfortunately, sorry, go ahead.
No, I was continue your thought there.
Okay, and unfortunately, this already compounds an already hawkish set of policies and group of advisors, that we saw with the whole trade war-related issue. Now, the question is whether the U.S. will use tariffs as a weapon to punish China, so to speak. We don't think so, because it's very economically painful to do so in a period in which the U.S. economy is already reeling from the worst recession on record.